work with a financial advisor versus self-manage all their money?
Well, there's a few reasons, but and that's a good question. I would say the first thing is time, training, and temperament. So the 3 T's, if people don't have time to do it themselves, if they don't have the training and they don't have the temperament, meaning the emotional fortitude to do it on their own, then they should potentially seek professional help.
What does the perfect asset allocation look like?
Dependent on client. So it's everything we do is client specific and customized to that individual or that couple. So there is no perfect asset allocations. It's predicated more on the particular client, but typically a diversified portfolio is beneficial.
Can you invest in Chinese markets?
Through ADRs, American Depository Receipts, you can get exposure to any foreign or most foreign countries through American stock exchanges. There are different ways to invest in the Chinese market, but nothing we do invest directly into Chinese A shares.
What about pink sheets?
Pink sheets may be appropriate for some people. I don't solicit business. I don't ask anyone to invest in pink sheet companies. That would only be something where I do it reactively. If someone calls me or has a special one-off that they want to invest in a small speculative type company, then yeah, we'll do pink sheets, but it's not something I would solicit someone's business on.
How about marijuana stocks?
To each their own. I mean, again, that's something that I think is a little bit more speculative. It may work out, some of them may work out very well, but I don't recommend those. I do have clients that have asked me to buy certain marijuana stocks for them, which I do. But again, it's something I would do reactively.
What do you do proactively?
Proactively, I usually try to use a 4-step process. The first step would be discovery, sitting down with a person or a couple or even a family and learning about their situation. What is your situation? How do you feel about risk? What is your tax implications? When do you need the money? Comfort levels? Do you have a will or a trust? Try to go through the whole workup of who are these people or who is this person? What their experience has been investing. And then secondarily, so that would be the first step is discovery. The second step would be recommendations. Once I learn what I would like to learn about them, I'll say, hey, this is how much I think you should have in stocks, bonds, real estate, so on and so forth. Third thing would be implementation. Do they want to implement all or part of my solutions? And then fourthly, an ongoing review and monitor. So I review all my client accounts every quarter, go over things and keep in close contact with my clients. So in a perfect world, that's how things are done. 4-step process, discovery, recommendations, implementations, review and monitor.
Do you have clients where you serve them at different levels, or is that basically the approach, the quarterly review for all clients?
Different levels, do you mean the relationship was initiated different than that process?
No, I guess I just mean more of an advisory role versus a management role.
Well, I'm not sure exactly what you're asking. On some of my client relationships, I'm a fiduciary, and some of them I'm not. So there's different relationships predicated on the type of accounts that are appropriate for the client.
Okay.
So there are brokerage accounts, and then there are managed accounts, and one it's suitability, and one it's fiduciary.
Explain that.
Okay. So traditionally through the years, typical accounts for clients were brokerage accounts, which are whatever I recommend or put clients into has to be suitable and appropriate for the client. Now the industry has changed because of Department of Labor regulations. There's more of a fiduciary standard. So more and more often now clients are working with me on a fiduciary basis where it's not appropriate and suitable. It has to be held to, is it in their best interest? So it's a higher level of responsibility, a higher level of care that has to be taken in those fiduciary client accounts.
Do you think that we have a massive correction coming?
I don't know, but I would plan for it. I mean, you don't want to own assets that you're not comfortable with, knowing that a correction may be around the corner at any time.
What kind of assets would those be?
Depends on the person.
Well, what's the best way to prepare for a correction?
To know that it's coming and have a plan mapped out prior to the correction, knowing that it's coming.
What would be in that plan?
an understanding of, see, that's part of the first step that we do during discovery is going over risk. If someone has, for example, maybe $500,000 they're considering investing, and we think a correction will draw it down by 30%, talking with them, hey, seeing that $500,000 lose $150,000, how are you going to feel about that? Because inevitably it's going to happen. We are going to have a correction or a serious pullback at some point. How are you going to feel about seeing your $500,000 go down to $350,000? And then bring that real heart to heart, and hopefully they're candid with me in their responses, and that they say, no, I'm really not comfortable with the value of my account going down by that much. And maybe it's more appropriate for them to have a more conservative portfolio, a little bit more money in bonds or a little bit more money in cash, so that when the correction does happen, that it won't take as heavy a toll on their account as initially we had thought.
For investors like that, when the correction does happen, do they end up buying more, or do they stay on the sidelines?
It depends on the investor personality. I mean, a lot of people that I work with are retired. So what they have invested is what they have. So if you have a portfolio with 60% in stocks, 20% in real estate, and 20% in bonds, and we've decided that that's the correct asset allocation for you, and then the market correction happens, they don't necessarily have more cash on the sidelines to get to work. So they just have to ride it through. There are some people that do think more opportunistically and may have a pot of cash that they're sitting on waiting for a downturn to happen.
Do you frequently trade for your clients, or do they have to call in trades?
I always trade for my clients. I mean, when I'm, especially on those fiduciary accounts, I mean, that's the whole purpose, and the whole point is to be managing my clients' money. That's my job.
But you have to get approval from them, or you just trade as you see fit within those accounts? So
there's a discretionary agreement that we work on prior to doing business. So if they want to work with me on a fiduciary basis, I ask them for discretionary authority. And if they grant that authority to me, then yes, I do act on their behalf when it's appropriate.
Do you have, what is your best, I don't know if you can say this or not, but what is your best value and growth stock at this time? Pick.
I'd be hesitant to put out any individual names, and just a word of caution to anyone that may be watching this. Anytime there's anyone on TV or any forum that gives a blanket recommendation to a diverse group of people, I would be cautious with that, because I don't know who's going to be watching this and what their situation may be. And the last thing I want to do is give bad advice to the wrong person. So I don't have any specific.
But at the end of the day, isn't it, if you're a fan of their business model, if they have good revenue and a good leadership team, it's a pretty solid recommendation long term.
Well, things change. I mean, no one thought General Motors was going to go out of business, or AIG, or a host of other companies. So things are always changing. And even though you may know something about a company, very seldom do people really understand everything going on about, myself included. I'm not an analyst. I don't have 30 hours a week to spend analyzing 4 companies. Very seldom do people really, really have an incredible working knowledge of a particular company in a particular industry.
Are analyst ratings reliable?
Some of them have better track records than others.
What about ETFs versus mutual funds?
They're both fine. I mean, they're different. An ETF has some attributes that are more akin to a mutual fund, and some attributes that are more akin to an individual stock. They are diversified, but typically they're unmanaged, unlike a mutual fund that's typically actively managed and diversified.
Do you have clients in crypto?
No.
None. Are you seeing more people buying or selling right now?
Well, most of my clients are holding. So
okay.
Yeah.
So time, temperament, and training. So clients don't have time to manage their money. They don't have the training, meaning explain the training part.
you have to have some understanding of, if you're going to be trading in individual stocks, it would be beneficial to you to have some understanding of, the fundamentals of business ownership. And unless you have, you can be self-taught, there's nothing wrong with that. But unless you have good, solid underpinnings there, educational underpinnings, it's going to be tough to make good decisions about what to own and when to own it.
Well, yeah, and I will lean mostly into your temperament point of view, because that's the one reason I use a financial advisor, because I at times see myself doing emotional investing, which you even know you're doing it and you still do it. And when I find myself emotionally investing the most, right before they release earnings every quarter. It's like a trap.
Well, it may be. I mean, you seem to be kind of geared more towards individual equities or individual stocks, where that's not common. Most people are more geared towards owning good quality diversified assets and having them grow for them over time. So it's seldom that people are interested in owning individual equities, and if they do, it's maybe a one-off, or hey, my kid works for this company, I want to buy some stock in Starbucks or whatever it may be. So it's not. It used to be more common for people to own portfolios with individual stocks. Fewer and fewer people own those types of things. Mostly mutual funds and ETFs lately.
Why?
Easier diversification, less risk.
The market's been on fire. So on the, I don't study the mutual fund market, which I believe you're alluding to. Are most funds up somewhere between what over the last 12 months?
Yeah, most funds is a tricky question because there's all types of different funds. There's.
But if they're diversified, shouldn't it all average out? That's what doesn't make sense to me.
What doesn't make sense to you? I don't understand.
This idea of these mutual funds are supposed to be diversified.
Professionally managed and internally diversified. That's correct.
And so theoretically, if it's unless it's truly an emerging market mutual fund versus a growth mutual fund, I guess you can't compare the two. But for each asset class of mutual funds, shouldn't the fund return, regardless of if it's company A, company B, company C's fund, perform generally the same?
No, I mean, that goes back to the quality of management.
Okay.
Some managers are better than others. And don't forget about ETFs. You can always passively manage through ETFs.
So I have to say that one more time.
Don't forget about ETFs. You can always passively manage through ETFs. Because when you or anyone else purchases an ETF or has money in ETFs, it tracks a certain segment. Typically, it tracks a certain segment of the market. Most ETFs are not actively managed. You're buying into a subset of the market, whether it's energy or consumer cyclicals or consumer staples or large cap value. So you're going to get the return commensurate with that particular asset class without it being managed. Okay.
Let's just take, for example, a mix of, a technology ETF or mutual fund, well managed over the last 12 months. What would a range see in terms of?
The last 12 months has been quite good. I don't know on the dot. I would have to look up a specific tech fund and give you a figure there. But yeah, the last 12 months has been good relatively across the board for U.S. equities.
I mean, are people seeing, like a 25% gain in their account value over the last 12 months if they're playing in ETFs and mutual funds? Like, because as you know, I take a lot of risk, and you do see that over the last 12 months with individual stocks. Obviously, are we seeing that with mutual funds and ETFs?
Adjusted for risk for the more aggressive stuff, yes. I mean, the market's been very good for more aggressive investments over the past year or so.
Okay. So then it's really, as long if you can play the risk game with mutual funds and ETFs, but you're saying that's safer than individual stocks still, because if one company fails, you got like a few others in there.
Right.
Is that what I'm hearing?
Yes, and generally these questions may be more relevant to you than to other folks, because a lot of people are more interested in when their statement comes, what's my bottom line? How much money have I made and how much risk am I taking? So performance management and fees. So performance is a big portion of the equation, but so is risk management. How much risk am I taking? And of course, fees are the third prong there.
Well, I agree with you. And what I'm trying to help other investors understand through these questions is, I think that individual self-managed investors that go on to their platform of choice to buy, they're picking equities most of the time. I think that most people buying mutual funds are using brokers. That's my assumption. Am I wrong?
I don't know. I've never seen the research on if individual investors are putting more money into individual equities or ETFs or mutual funds.
Okay. So yeah, I could have a faulty assumption there. But I think, when you turn on CNBC or Bloomberg, they don't really talk about mutual funds.
They don't typically. That's right. They're not as sexy. I mean, they don't, on those shows, a lot of times they want to talk about what's new and what's hot, what's great or what's horrible. But they don't really talk about what's boring and conservative, but works out very well over the 20, 30 years.
So most of the folks who are retired or about to retire, am I hearing you right? They don't own many individual stocks?
I would say, I don't know with certainty. I've never personally studied the matter, but from my experience, just from people that I've run into over the last 15 years, I would say that most people that have been employees of companies, that the vast majority of their wealth is in cash, be that at the bank, and then mutuals or some other diversified investments. Yeah, most people don't buy individual stocks that much anymore. It used to be, there's been a whole, just a continuum of changes in the investment world. It used to be investors bought individual stocks and individual bonds. Very seldom now do people buy individual bonds, and most do-it-yourselfers, I guess they're buying individual stocks. I don't really know exactly what they're doing.
Okay. So people will come to you because they need help finding the right investments for their lifestyle, where they're at in terms of their journey. And they basically can review your performance. How do they know if you're doing a good job?
Well, I do have reviews with clients every so often. It's predicated by the clients, just when they want to visit, but usually we visit once a year, and then we talk over the phone more than once a year and review their account, see how the performance is going. But again, the investments are very important, but they're part of the plan. The idea is to have a plan. If someone's getting ready to retire, how much income do they need? The investment portfolio looks very different for someone that's going to be in the income phase of their life. They may have gone for 30 or 40 years in that accumulation, and now they're transitioning towards a distribution phase. The important thing is the client goals. What are they trying to accomplish? Do they need income? How much income do they need? How much risk are they willing to take? Do they have assets elsewhere? Do they have rental properties? How does this fit into their big picture? So the first thing is the plan. That's the idea behind going through the discovery process, is to formulate a plan for them. And then the investments fit into the plan according to all their specific criteria.
What would be income? I mean, is that just dividends, or are you talking about annuities, or?
I'm very careful with annuities. You have to, and I urge caution when it comes to any insurance products. But in general, income can produce different ways, from distributions from mutual funds, from dividends from stocks, from interest payments from bonds, and it also can be from sales. Just using mutual funds as an example here, you can sell off a portion of your funds every month or every quarter, or every year, in order to produce the income. So there are different ways to get income, but that's a real good question, is how are clients getting income from their accounts? There are many ways to do it, and you have to be very careful. Most people can't afford to make a big mistake in their retirement accounts. That's something you haven't asked about that is critical to a lot of people, especially people that are getting close to retirement age, is how are they going to get the income from their accounts? And be very careful with insurance products, mainly annuities.
Why?
Hidden fees would be the biggest reason. And secondly, illiquidity. if they need a lump sum to come out of there quickly. And then usually, and not always, but they don't produce greatest returns because of the internal operating expenses. So just be very careful on annuities. Just a sidebar there, when you're looking at annuities, the question is, are the fees worth the guarantees? So everyone should know that annuities have higher fees typically than most investments. And that can be okay sometimes if they're willing to pay higher fees in order to get the guarantees associated with those fees. So it's a balancing act there. And people, before they go into any insurance product, should understand the fees involved.
I mean, I don't even, can you explain it like it, if I, you know, what is an annuity in the most simple terms?
There are different types of annuities. There are fixed annuities and there are variable annuities. But generally what you're doing is you have a contract with an insurance company, and that's it. They have their end of the bargain to hold up, whether it's producing income or principal guarantees. Something is going to happen with your money, and they're guaranteeing or backing that. And it depends on exactly the annuity contract. Some annuities are very simple and they're almost like CDs. Some fixed annuities are very simple. Some annuities are very complex, and there's all different types of rates of returns associated with them. I would just caution people, just be very careful with insurance products.
Well, then let's go back to the question on income once you're, retired. And I like the idea of, selling as needed, to have cash. Is there limits from retirement accounts, how much you can take, or?
Typically, it's the opposite, is that there's mandatory distributions, that there aren't limits on the upside, meaning you can sell as much as you want, but typically there are minimums that you have to sell at least this much to withdraw from some type of retirement account, required minimum distributions. So now the new age limit is 72. Once a person turns 72 years old, they're required to start taking money out of their retirement accounts.
And these people who are retiring or have left their jobs, is it required that they roll over their 401k into an IRA, or just be very disadvantageous not to?
Sometimes they are required, but usually, and it can be advantageous or not, so if they're in my opinion, if they're working with a capable, decent financial advisor, it is in their best interest. But you have to go through the options and you have to explain the options to them. And some companies do require people to take their money with them.
What would be the reason to leave it in the 401k? Just because?
Sometimes the fees are lower.
The fees are lower, okay.
Sometimes, not always. If it's a large 401k with billions of dollars in it, the fees may be lower, but there are limited options. Typically, there are limited options, and they may not be getting any guidance or advice.
So when this client will roll over their 401k into an IRA to get more options, it sounds like still most of those options are generally mutual funds.
Mutual funds, ETFs. I mean, you can always go into individual stocks, but you were asking some questions earlier, very pointed, specific questions about pink sheets and different types of individual stocks. And most people are not, my experience has been most people who are retiring are not interested in that. And that's more.
I don't hang out with many people retiring, sorry.
I hang out with a ton of them. Yeah. So different strokes for different folks, but most people's main concerns are, depending on the person and their individual situation, am I going to run out of money? That's, so some people are very wealthy and it's not a concern, but for a lot of middle-class people am I going to run out of money?
When they're retired, they start to worry about that, is what you're saying.
Yeah, actually, probably about 2 to 3 years before they actually retire, those questions that had been in the back of their mind move to the front of their mind, and it becomes more of a pressing matter for them. And people also, I know you're a young lady, but people also change the way they think about things over time. Your way of thinking changes with the experiences you've encountered in life. And if you saw your 401k go in half in 2008, and then maybe even before that, if you were in the market in 2000, 2002, you saw it go in half. And then recently with COVID, you saw it decline significantly. When someone experiences this over and over and over, and now they're mid 60s, and they're thinking about retiring, Medicare, Social Security, Do they still have a mortgage? There are a lot of things that play into it. But if you have a number of bad experiences or significant losses, you may be more concerned about preventing losses as opposed to getting exceptional growth going forward. So everyone's different. That's a broad generalization.
Yeah. What percentage of working Americans invest outside of retirement accounts?
I don't know.
Okay. What percentage of working Americans have 401ks? It'd have to be pretty high.
Yeah, I don't know the specific numbers on that either, but most people that work for larger employers, I'll say 100 or more employees, most are offered some type of 401k plan.
Is there something that a 29-year-old, should they be putting discretionary income and maxing out that vehicle, or are there other vehicles they should be looking at?
If someone's offered any type of retirement accounts, especially if it has a matching contribution, I would highly push them or encourage them to max it out. When you're young, from the time you're, say, 19 to 40 years old, if you're putting away a lot of income during those years, if you're making decent money, it's very impactful in your 60s. It's incredible how that compounding works.
Why do they have a max? Why can't you put it in as much money as you want?
I don't know why they have a max. Maybe the government doesn't want to lose that many tax dollars.
Oh, okay. All right. Awesome. Any final words of advice from yourself, a professional investor, to anyone out there?
Well, I'm a professional financial advisor, and I would say the words of advice would be careful and work with someone that you feel comfortable with, work with someone you trust, and just be very careful.
All right. Thank you.
Thank you, Aimee.
For more, please visit www.momsofmaternity.com.